Hey everybody, Chuck Barone. Thursday, March the 23rd, 2023, and the beat goes on, man. Wow, we are in some crazy times, guys. You guys have been hearing me ragging about it going on and on and on. I can't understand how, we can't seem to get our heads into anything and do anything right anymore. It's just really sad. Today, another crazy day in these markets. More pressure on the Fed. It's going to be the finish of this month is just going to be a wild one. Anyway, before we start this show, as always, we want to welcome you guys. Thank you for your support. We appreciate all you guys do watching the videos and your likes and shares, questions and comments. It means the world to us, guys. We appreciate it. Markets today. Well, we knew today was jobs day. So the market was kind of getting off, kind of just, waiting for the news. Boom, here it comes. Kind of hot. Market whipsaws around. Ending the day up. Go figure, right? So the Dow up 75 points today. S&P up 11. NASDAQ up 117. There's no rhyme or reason to this market right now, guys. There really isn't. If you're a trader, if you're trading right now, day to day, you're going to be loving this market because it's just whipsawing all over the place. So, if you can bet right once in a while, you're going to make some scores. But if you're a guy like me who doesn't want to be trading every day, wants to invest and build positions and invest over a long haul, these ups and downs and all arounds are just crazy every day, just crazy. So the stock market, basically all about interpretations. Today we're digesting a lot of different data. We'll go over all that data in the comments, but somehow or another the market's eking out a gain. Bonds also rally today. Go figure, man. So people buying bonds, yields falling, the 10-year dropping 10 basis points to 3.40%. The 2-year dropping even further, dropping 18 basis points to 3.80%. So now the inversion, which was just a couple weeks ago, was 108, now is narrowed down to 40. I don't know if it's going to actually get right side up. I doubt that, but this narrowing would indicate that the recession that we still haven't got to yet, that the Fed is doing everything in its power to create, has not happened yet, obviously, and the bond yields are indicating that if it does happen, it may not be as deep as once thought. The dollar today, basically a flat day, change of 1/100th of a point, 102.51 on the index, no change in the dollar. Not a great number, especially compared to where it's been, but still pretty strong. But in spite of that, gold and silver today, precious metals having a really nice day, man. Gold up $27, $1,998.10, was over $2,000 again, trading for a while. Any second now, guys, $2,000 gold. I've been saying it for a month. It's going to happen. Metal's been wanting to rally. Here it comes. Silver up only 11 cents today, but $23.06. Looking like it's going to make a run at $25. Precious metals looking great. I know a lot of people watching this show are invested in precious metals. Nice to see you guys making some scores here. Yay, team. Oil today, well, down $1.68. $69.22 for a barrel of West Texas Intermediate. After hours trading yesterday had it above 70. Right back down into the 65 to 70 trough where it's been. Looks like it's going to stay there. We'll see. We'll look for a breakout up or down. Keep you guys posted. Bitcoin today rallies late, up $1,247, 28,218. In spite of bad news, man. I mean, Coinbase got some bad news today. It looks like the SEC is going to have some issues with them. The ongoing FTX and Bankman fraud and all of those guys. Crypto's been getting whipped around, but holding up, man. Holding up. And I was reading, they said Bitcoin could reach $100,000. So this market is not a dead one. Those of us who don't really understand cryptos want to be a little bit skeptical, which is understandable. But if you're invested in this and you know what you're doing, looks like you got a shot at making some real money. News you guys need today. Well, the big news of the day, the news we were waiting for, unemployment numbers, jobs again, man. The numbers coming in lower than predicted, coming in at 191,000 versus 197 expected. They keep lowering the number. Like, okay, well, you know, usually it was around 250, then they lowered it to 230, 225. Every time they lower it, the real number keeps coming in lower. Pressure on Powell. We know Powell's been looking at the jobs, the hot jobs market. We know he wants this to happen. We know what he wants to do to this job market. He wants to crater it. He wants unemployment up. He wants to take the wage pressure off. Wage growth slowing, but still pretty hot, especially for all of a sudden people who are staying in their jobs getting big raises to stay there. Still 1.9 jobs for every person looking for a job. You know, the labor market's sizzling hot, man. It's just what it is. You know, I know a lot of guys doubting these numbers. We only can work with the numbers we have. And these numbers, if they could manipulate the numbers as much as we'd like to think they can, I would guess this number would have came in at 200 today or something of that nature, not sizzling hot. But now, the pressure is really on Powell, man. You know, we had another issue today with a bank in the Pacific West. Big trouble, Pacific West. They had to get they got a $1 billion lifeline from Apollo. Okay, nice job, Apollo. And they've had, this is not a giant bank, $30 billion regional bank. But they had more than 20% of their assets withdrawn from the bank since the beginning of the year. So that's the start of a bank run. They're hanging by a thread. Banks in big trouble, but job market hot, inflation numbers still hot. The Fed's in a tough spot, man, because you know the tendency, they want to continue to raise rates. They want to get this inflation number down. I think we'll probably see another quarter next time they meet. I guess it's May now. That'll be here before we know it. I think we'll probably see a quarter there. That'll get them to their about 5.10 on the overnight fund. We know they wanted to get above 5% terminal rate. We'll see if that's enough. But it looks like the pause is coming soon. Maybe the second half of the year. Powell, in his discussion yesterday, certainly, indicated there would be no rate cuts coming this year. It was interesting, that change in language yesterday. We talked about that on the show, how, went from the Fed saw ongoing increases to now it was more tempered. He was saying that as needed or as indicated or something of that nature. So might be time for the pause. I still think we'll get one more in May, but we'll see where the data takes us between now and then, because it's a very, very, very fluid situation between the banks, the economy, employment sizzling, and inflation. It's a very, very delicate deal he has to deal with here. I guess that's why he gets the big bucks, right? But he's going to earn his money today. Today we had Treasury Secretary Yellen. I cannot mention her name without wondering how in the heck she got where she is. She must be like really, really, really brilliant behind closed doors, because what I've seen of her in the public, not super impressive. Here's a woman who's former Fed chair, Treasury Secretary, can't get out of her own way, can't walk and chew gum at the same time, man. So she's out today trying to walk back yesterday's comments. You guys remember yesterday she totally spooked the whole market by saying that the Treasury was not considering expanding deposit insurance. Today, here's the quote. It was, "We have used important tools to act quickly to prevent contagion. And they are tools we could use again," unquote. So basically, yesterday it was, we're not considering it. Today it's like, well, we have these tools where we can consider it. We can do it anytime we want to. I don't know how they get away with that. You going to pick and choose? Because it would seem to me it has to be all or none, right? You can't, okay, well, we're going to cover all the depositors in Bank A, But because Bank B is not a bank we like, or for whatever reason, we're not going to cover those depositors. I don't know how that would go over. I think that would be lawsuit city, man. You'd be, getting the Supreme Court involved. I think that the Treasury, the FDIC, cannot back up every single regional bank should they all go belly up, man. It's just not enough money in the world for all of that. So it's going to be fascinating, crazy, to see how they try to weasel walk this one, man. Are they considering it or not, man? I mean, they want to lend confidence to depositors who they don't want everybody running to the bank to pull their cash out, like they might do, especially uninsured money, if they felt like the FDIC wouldn't make everybody whole. And I don't think they will. I think that they shouldn't. It creates a moral hazard where people can ignore the FDIC limits because the limit really doesn't mean anything if they're going to back up every dollar above that limit, does it? So Yellen out today, just comical, man. Just not a very good speaker. She does not inspire any kind of confidence, at least in me. The Federal Reserve, what they're expecting now with the situation with banks, with higher rates, with the inverted yield curve killing lenders, they're expecting to see tighter lender credit, or tighter credit standards for lenders. They're expecting to see more loans declined, much more difficult to obtain loans. Of course, the funny thing is how that'll work, right? So conventional borrowers and people with good credit or, big assets, people who don't need the money, in other words, will be able to get all the loans they want. People who are more marginal with less credit, less collateral, less history paying, well, there's going to be subprime city for them. That's where they're going. Just like they did with the auto loans, where they're paying much higher rates and now defaulting and, going terminally late. That's where we're going to go with every banking lending situation now, because the Fed really wants banks to tighten down. Banks tightening lending standards actually works like a de facto rate increase. And if they're turning down a certain percentage of loans, that means, that would be equal to a certain percentage of loans that would not apply because rates are too high or whatever. So interesting tactics. We'll see if it works, right? A couple things to finish that I thought were really interesting today. So they did a labor survey. This was through LinkedIn. And the survey showed almost 70% of the workers surveyed said that they will quit their job this year in 2023. 70%. Well, this explains why businesses are paying people more to stay on the job, why a lot of these job openings are not getting filled. It looks like labor in America's kind of just about had it with the old routine of you report to the office, you get there a half an hour early, you got to clock out for lunch, the working man getting pulverized, not making any real money, while the rich and the top of the food chain gets just fatter and fatter and more bloated, while demanding more of working people without paying them more, or if they are paying them more, not even keeping up with inflation, right? 70% said they're going to quit this year. That would be quite a turnover in our labor market. I think they said that a lot of these people, especially the millennial and Gen XYZ peoples, all of these younger groups, most of them talking about trying to be freelance, independent contractors, or starting their own companies. They don't want to have bosses. They don't want these 9-to-5ers where you have to show up and be at the office every day and basically, take a job, work till you drop, no fun in between. You get to have your family and your kids, but everything revolves around your job, your health insurance, your very way of life, your rent and all your bills. Looks like people are there's maybe a very quiet revolution underway where businesses are going to be forced to actually pay people money and not have all the money go to the people at the top and the shareholders, which just cracks me up, man, because they don't give a crap about the shareholders. They just want you voting like sheep by proxy, so they can run the company and make their millions and millions of dollars. But labor, this survey tells me that this labor market is a little bit different. That just adds more complexity to Powell's job, because if people quit, those openings are going to have to be filled. It's just going to create a vicious cycle. We get that wage price spiral. We've talked about that since last June. We're kind of in the middle of that now, trying to get out of it. It's not severe yet, but it looks like it could get severe, especially if all these people actually follow through and do leave their jobs. Crazy stuff. The finish today, credit card debt reaches record levels. People charging more, can't make ends meet, using credit cards for everyday purchases, gasoline and food. They said that 46% of people surveyed are now carrying credit card debt from month to month. That's up from 39% a year ago. So people not being able to pay off the balances on those cards and having to carry balances from month to month, of course, which increases the cost of that loan pretty dramatically. Right now, the average rate on credit cards, 20.4%. It's the highest since they started measuring rates in the mid-80s. 20.4%. I hope the people who've been watching this show regularly, our regular viewers, have been paying attention. Put the credit cards away, gang. 20% on your money, really? That's almost, that used to be called usury. It used to be against the law, okay, to charge rates like that. Now it's just everyday standard operating procedure, man. Crazy, crazy, crazy stuff. Well, guys, we're really in the pickle here in the U.S. We got problems, problems, problems. Sadly, they're not going to solve themselves, and we don't have a government, people in government capable of solving our problems for us, it looks like. So it's going to be us to take care of ourselves, guys. To say what we've been telling you still goes, man. Be very cautious. Save your money. Don't take on new debt. Invest very cautiously. You know, a smaller return is better than a loss. And spend your money frugally, man. Be thoughtful. Buy what you need to buy. I'm not saying don't spend at all. But just be thoughtful about how you're spending, what you're spending it on. Avoid the impulse stuff, man. That's where you get in trouble. At least that's where I always got in trouble. And hold on to that money. You may need it, right? This recession's coming. It's just, there's just so much conflicting information. But the oldest saying in Wall Street is, well, since 1913 at least, don't fight the Fed. They're going to get that recession they want. Believe that, guys. And the chances of a soft landing, well, like I said, picture the Hindenburg exploding. That's what the economy is going to look like later this year. Who knows? Maybe sooner, depending on how this bank thing continues to play out. Live in history, guys. Live in history. Anyway, tomorrow we'll be here Friday. Wrap this week up. Hopefully it'll end with some good news for everybody to take in over the weekend. We'll be back to bring you guys all the details and their magnificent and gory, all the particulars about everything. And until then, guys, see you tomorrow.